Welcome everyone to the second pre-recorded lecture for the Mises Academy online class, Anatomy of the Fed. This is lecture 2, The Theory of Central Banking. Now this lecture is going to rely very heavily on the PowerPoint presentation to the point where you really are going to need to have it on your computer to refer to, or perhaps to print the slides out so you can at least be going through them. In fact, I would recommend that above anything else, to get the PowerPoint on your computer and actually print the slides out so you can have them on paper in front of you and you can compare them to see several at a time while I'm going through this, because we're going to be looking at balance sheets of banks, and it's the kind of thing where if you really follow the numbers and have to hit pause on the video lecture so that you can check my math and make sure you understand the argument, you're going to understand this topic a lot better than if you're just sort of tuned in halfway, kind of following my general observations, but you're not really checking the numbers yourself. Okay, so again, I would stress, to get the most out of this lecture, have the stuff in front of you and follow along, and stop me when you need to make sure you really understand the argument. Okay, so now I'm going to move to the first main slide, which is the outline. Now I should point out that even though this dovetails with Rothbard's book, Mystery of Banking, specifically the chapter on the theory of central banking, or removing the limits, I think he calls it. It's his first one, chapter 9 in that book. The material I'm going to be covering in this lecture actually could more appropriately be titled The Theory of Bank Balance Sheets, or something like that, because I'm not going to really even be talking, except at the very end of this lecture, about central banks per se, because I think Rothbard does a great job discussing that. And what I really want to hit home in this is to make sure you guys taking the class understand how a balance sheet really works and what happens when a commercial bank engages in a fractional reserve loan. All right, and it creates money out of thin air. Okay, because that's a crucial part of this. So I'm going to say it now, and then we're going to build up to that near the end of this lecture, and I'm going to repeat it at that time. But I just want you to realize it's not the case, at least in the Rothbardian framework, it's not the case that a central bank is the sole culprit when it comes to generating credit inflation and the boom-bust cycle. It's rather that Rothbard says it's fractional reserve banking per se. Even if a private commercial bank does fractional reserve banking, Rothbard argues that is illegitimately counterfeiting money, as it were, creating money out of thin air, and setting in motion the seeds of the boom-bust cycle. Now, what we're going to see is that left to its own devices in a market economy, there are strong market forces to limit fractional reserve banking. And that Rothbard argues the whole point of central banking is to break down those limits, to foster the inflationary engine, to sort of encourage the type of inflation that individual commercial bankers want to engage in, but yet they're normally restrained by market forces. Okay, so that's a very important point that I think a lot of people who just have a passing familiarity with the mechanics of banking, when they read the Austrian literature, they just assume that, oh, it's Ben Bernanke, it's the Federal Reserve that creates money out of thin air. And that's true, but it's beyond that. It goes beyond that. It's also commercial banks themselves. When you go into a commercial bank and you apply for a car loan, unless that loan that they give you is backed up 100% by reserves, meaning in our economy, paper dollars in the vault or reserves on deposit with the Fed, then that also is inflationary. The mere act of that commercial bank giving you a loan so you can go buy your car from the car dealer, the bank has just created money, at least under certain definitions of the money supply. Okay, so I'm sort of anticipating where we're going to go here, but I want to make sure you grasp that aspect of this. So that's why, in case you're wondering, why is Dr. Murphy spending so much time focusing on an individual bank's operations? When are we going to get to the fun stuff? When the Fed comes along, or the central bank comes along and starts creating money out of thin air through open market operations? That's what I'm telling you. That don't think of it like that. That the essence of what's going on here is fractional reserve banking, again in the Rothbardian view, and the danger of the central bank is not merely that it creates money when it buys assets and creates new reserves. Stuff that nowadays we would like quantitative easing and say, oh, the Fed's going to buy $600 billion of new bonds. Where's it get the money to do that? Oh, it creates it out of thin air. I mean, that's kind of stuff people are talking about right now. But in this class, we want to go beyond that and see that in Rothbard's view, it's, again, the commercial banks themselves through fractional reserve banking that create money out of thin air, push interest rates below where they ought to be, and so forth. All right, so that's why I'm going to spend so much time on this, because if you get it at the individual commercial bank level, then it's pretty easy to just generalize and to see, okay, if the commercial bank now is a client of the central bank and how that works. So again, that's why, to make it as simple as possible, I'm focusing so much on the balance sheet of a commercial bank. Okay, so the next slide is Roman numeral 1, balance sheet basics. So here, this is going to be simple for those of you who are actually in the financial sector, but I don't want to assume anything on the part of the students here. So this is a balance sheet showing sort of double entry bookkeeping, or it's often called a T account. And it's very simple. On the left side, you've got your assets. On the right side, you've got your liabilities and your shareholder equity. Okay, so as we go through the numerical examples, this is going to be a lot clearer to you if you've never really worked with something like this before. So I just put one little equation here underneath showing that, because to some people, it seems a little counterintuitive, because what's always going to be the case with the balance sheet is that the stuff on the left-hand column is going to add up to the stuff in the right-hand column. Okay, so to some people, it seems a little odd that why would assets equal liabilities plus shareholder equity? That those don't seem intuitive. So I rearranged that same identity to say that total assets minus total liabilities equals equity. And that should make sense to people, okay? Because the idea is the shareholders legally own the corporation. So whatever net assets the corporation has is the property of the shareholders. So how do you figure out what the net assets are? You say, okay, what are its total gross assets? But then it's not enough to say, oh, so now the shareholders split that up, because what about things that the corporation owes to outside people, creditors, people who lent the corporation money, or people to whom the corporation is liable financially? So you can see, okay, to really understand what do the shareholders actually own free and clear, it would be the total assets minus the total liabilities. And then that whatever's left over, the sort of, assets that have no other claimants on them, that's what the shareholders own. And so that's how the balance sheet works. So it's just a rearrangement of terms that, okay, that's why if you've got total assets on the left side and you have all the total liabilities on the right-hand side, then the last entry you put on the right-hand side is shareholder equity. So really all you're doing there is showing that the shareholders own whatever is left over after you've subtracted the liabilities away from the assets. I don't have this on the slide, but just to make sure you understand. So when you talk about a corporation becoming insolvent, you mean that equity goes negative. All right, so if a corporation's bankrupt, if it's insolvent, it means that their liabilities are bigger than their assets. They don't have enough assets to satisfy all their creditors. And so that means, somebody's got to take a hit. The corporation can't pay off everybody. It's got to go into bankruptcy. Right? That's the idea. Okay, another little point I made here is that the balance sheet is a snapshot in time. So at any given moment, boom, you freeze things. You say, right now, this second, what are the total assets of the corporation in terms of their current market values, the total liabilities, the current shareholder equity? In contrast, if you want to say what's the income of the corporation, or you want to say, let me see the profit and loss statement, those concepts are flow concepts. They're not what's called a stock concept, like a static point estimate. They are a flow that occurs over a certain time period. So let me just give you an example. It would make sense to say, right now on Friday, January, I think it's 14th, at 12:30 p.m. Eastern Time, what are the total assets of IBM and what are the total liabilities of IBM and what's the size of its balance sheet? I mean, we might not know those numbers exactly just because we don't have the information at our fingertips, but it makes sense to talk like that. But it doesn't make sense to say, what is the income of IBM at this particular moment in time? because income refers to a time period. You could say, well, I can tell you the income over the last quarter, or I can tell you, over the last 12 months what the income has been, but it doesn't make sense to say what's the income right now, okay, because income is something that happens over a period of time. Okay, next slide, introducing the topic, Roman numeral 2 of loan banking. So here with my silly pictures, I'm just trying to remind you that everything that I'm going to talk about in this section, Murray Rothbard is totally fine with. All right, so we're going to get into stuff about people defaulting on loans and the shareholders losing money and so forth. That's fine. I mean, it's regrettable, but there's nothing fraudulent about that. Okay, it's okay in the market for investors to put money into a bank. The bank makes loans and they make a mistake, or it's a mistake. I mean, they might make plenty of loans knowing that a certain fraction of them are going to default, and so in that sense, you could say it wasn't even a mistake. But clearly, if the loan officer at a bank knew the money that they were giving to a particular borrower wasn't going to come back because the person was going to default, then they wouldn't give them the loan in the first place. There's no way around that, right? Unless there's some strange government program involved. Okay, so that's the sense in which I mean these loan defaults require entrepreneurial errors. But my point is, don't think that that's the kind of thing that Rothbard is against when we say he's against certain practices in the commercial banking sector. We'll see later on in the lecture the kind of thing Rothbard's against. So everything under loan banking is perfectly admissible as far as libertarian theory or Rothbardian take on it. Okay, so letter A, capitalization. So at this beginning stage, we're going to look at a particular bank in the free market that's being formed here, and then we're going to follow it through some potential scenarios. So what I have in mind here is that 20 investors each put up 50 ounces of their saved gold. So let me just mention two things in terms of the pedagogy here. I'm using gold, so in all these examples in the balance sheet and so on, I'm going to have ounces of gold as opposed to dollar signs. And I'm doing that because I want to really isolate the essence of banking and fractional reserve banking in particular and what happens with the balance sheet there. So I don't want you to get confused. If I were to use dollar signs, even if I said $50,000 in gold, like Rothbard does in his examples, I'm afraid some of you would be picturing it in terms of dollar bills, and you wouldn't be divorcing yourself from the idea of fiat money. So I'm purposely trying to make you think by making these things a little bit jarring. So that's why I'm using ounces of gold. And also, you'll notice the numbers that I've picked, they're not nice round multiples of 10. So you might wonder, why am I using 20 investors putting up 50 ounces of gold? Why didn't I say 10 investors putting up 100 ounces? It's because I'm afraid if I start using multiples of 10, you're going to be thinking in terms of reserve ratios that you learned in your econ classes. And I don't want you to think that right now, because that stuff, right now, that sort of thing means nothing. We're not talking about reserve ratios. There is no central bank enforcing a reserve ratio right now. This is just a commercial bank in a free market economy. There's no such thing as a central bank. Okay? So that's, and anyway, this is loan banking, so there's no issue of reserves at all. So that's why I'm choosing it, in case you're wondering what guided me in picking these numbers, is I'm making them cumbersome to force you to do the math from scratch and not just be lazy and think you know what the answer is going to be. Okay, so the asset side of the bank, you say, well, what are the assets of this bank? Well, each of the investors put up 50 ounces of gold, so they have 1,000 ounces of gold in their vault. I mean, technically speaking, you could say their asset is the vault itself, because if they went out of business, they might be able to sell that on the secondhand market. But let's forget the physical building. When I talk about the assets, we're focusing on the actual physical yellow metal that's sitting in the bank vault. That's an asset. They own that outright. The investors put that into the business originally. It's theirs free and clear, so it's an asset. On the right hand side, there's no liabilities. Okay, so the 1,000 ounces of gold is all shareholder equity. Okay, so they haven't done anything yet. They just formed their bank, and they've each chipped in 50 ounces of gold, and there's 20 guys, or 20 men and women, let's not be sexist, who have founded this new bank in Libertopia. Okay, next slide, letter B, making loans. So now this bank is going to make two separate loans. it's going to lend 400 ounces of the physical gold to Jim and another 400 ounces to Sally. But for whatever reason, Jim is considered a safer loan, and so they only charge him 5%. Sally is riskier. She explains what her business model is and what she's going to do with the money. And so, if it pans out, if what Sally wants to do works, she'll have plenty of ability to pay them back, the 20%, but it might not work. Whereas Jim, what he wants to do with the money, he's been in business for years, and they're pretty sure, it's not likely that Jim's going to default, so we can give him the loan at 5%. And of course, I didn't mention this in the slide, but why would they just charge everybody 20%? Well, because of competition. Because Jim is a safer loan, a safer risk, I should say, if they tried to charge him 10%, he could probably shop around and get a loan at a lower rate from some other bank. So that's why, to be competitive, they can't overcharge. But yet they got to protect themselves. They can't give Sally the loan for 5% because there's a good chance she's not going to pay it back and they'll lose money. Okay, so in terms of the balance sheet, what does this look like? Well, on the asset side, remember, they started out with 1,000 ounces of physical gold in the vault, and they just handed out 400 to Jim and 400 to Sally. So that means they only have 200 left sitting in the vault. Okay, now those aren't reserves because this is not deposit banking. This is loan banking. Okay, there's nobody who could come in at any moment and say, "Give me some of my money," and then I say, "Oh, phew, it's good we got those 200 ounces there." No, I'm just have the 200 in there, just so to make sure you understand that I'm taking away the 400 loans from the original 1,000. That's why I kept the 200 there, just so you can be straight as to what's happening with the money. That 200 ounces isn't backing up anything. That be sure you understand that, okay? Because this is loan banking. Now, on the asset side also, what does the bank have? It has IOUs from Jim and Sally. So what Jim did, he signed a legally binding contract saying, I am receiving 400 ounces of gold from the bank today, whatever the date is, and in 12 months' time, I will return to the bank 400 ounces of principal plus 5% interest. Okay, so that is an asset. The bank has this legally binding document that says this guy, Jim, whatever his last name is going to pay the bank, what would be 420 ounces of gold in 12 months' time. So that's clearly an asset. It's like a bond, except it's issued by a person rather than a company. And a similar thing with Sally. Now, when I evaluate the market value of these bonds, you have to use the present market value. It's true, in 12 months' time, that IOU from Jim is going to be worth 420, and the IOU from Sally is going to be worth 480. But I wouldn't write those values in right now because it's not 12 months from now. We're talking right now. All right, so that's one thing, incidentally, that's a little bit... It's not that it's wrong on what Rothbard does, because Rothbard's trying to not deal with 9 different things at once. So he's trying to isolate 1 or 2 main points for the reader, and he's trying to keep everything else simple. So in at least some of the balance sheets, I noticed that Rothbard does this kind of stuff. He writes in the value of the loan with the interest already accrued. And I'm worried that might confuse some of you, so that's why I'm doing it this way. So I just want to make sure I'm announcing explicitly the way I'm doing it here differs from how Rothbard does it in at least some of his examples. And the reason I'm doing this is because this is more technically correct. I mean, again, it's not that Rothbard doesn't know what he's doing. He's just trying to simplify it. Okay, but technically, at the moment the loan is made, it's only worth the face value. Okay, which kind of makes sense that the loan, obviously, to Jim, when he gets the 400 ounces, is worth 400, and so the thing he's exchanging to the bank also has a market value of 400. It'd be like, if you buy a car for $1,000, you say, what's the market value of the car? It's clearly $1,000, right? Even though the subjective preferences are different, and that's why people do the trade, the market value of what they're trading is equivalent, because that's what it means for market value. It means what can you fetch in the marketplace. So the bank is paying 400 ounces of gold for Jim's IOU. Think of it like that. The bank is buying a bond from Jim, and it's paying him 400 ounces. So if I ask the second after the bank makes that purchase, how much is that thing worth that you just bought? Well, it's 400 ounces. That's what we just paid for it. That's this market price. Looked at another way, if the bank for some reason had to liquidate these loans, right? If they needed to raise physical gold for some reason and they wanted to sell the loans from Jim and Sally to some other financial institution before Jim and Sally owed them the money, well, they couldn't sell it for the full matured value because the other bank would say, no, I have to wait around a year for those guys to pay off. Right now, I'll only give you $400 for that thing. Okay, so that's why the IOUs are priced right now at less than what their face value will be, in a sense, if you took into account the interest that would accrue. Okay, and then on the liability side, it's the same thing. There's still no liabilities. Okay, because liabilities from the bank's perspective mean people to whom the bank owes money. But right now the bank doesn't owe anybody money. People owe the bank money. Okay, so there's no liabilities. That means the $1,000 in assets is all represented in the shareholder equity. So at this stage, the shareholders haven't made or lost any money. All they've done is converted their assets from one form to another. Originally they had 1,000 ounces of physical gold. Now they have 200 ounces of physical gold and two separate 400 ounces of market value determined IOUs from people. Okay? And of course my computer's freezing up. Okay. All right. So next slide is number one, payback. So here, what we're doing is, what we're going to do, just to anticipate, we're going to look at two different scenarios. One scenario, we're going to say, what happens if Jim and Sally both pay back their loans just as their contract specified, and we'll look at what happens to the bank's balance sheet and the shareholders. And then the next scenario, Sally's going to default. So we can just see how those things play out. But so for right now, easiest case to consider, assume a year goes by and now Jim and Sally both pay off their loans. So Jim pays back a total of 420 ounces of gold, and Sally pays back 480. So for simplicity, just assume they walk in with physical metal, actual gold coins, let's say, or bars of gold, depending on how heavy they are. Okay, so they walk in, a year has passed, Jim and Sally's businesses both do well, and they earn revenue from their customers, and Jim walks in, hands over a bag full of 420 1-ounce gold coins and says, there you go, you and I are square now, thanks for the loan, walks out. So Jim and the bank's relationship now is terminated. Sally does the same thing, but since she had a higher interest rate on her loan, she, of course, has to give him a bag full of 480 1-ounce gold coins. Okay, so now we say, okay, what happens to the bank's balance sheet now? Well, the asset side, those loans are gone, right? That Jim and Sally, before, the bank was holding legally binding documents signed by Jim and Sally entitling the bank to payment from them. And in theory, the bank could have sold them to somebody else. So those were clearly assets. But now that Jim and Sally have paid off their loan, those IOUs are satisfied. They get, they're completed. So they're not assets anymore. They're done. So those disappear. But the bank has a lot more gold in the vault. So remember, before it had 200 ounces, now Jim just gave it 420 and Sally gave the bank 480. So that's 900 total ounces more, plus the original 200. That's why at this stage there's 1,100 gold ounces sitting in the vault. There's still no liabilities. So that means the 1,100 ounces now is all owned by the shareholders, spread among them equally. So that works out to an average of 55 ounces of gold per shareholder, because there's 20 of them, remember. All right, so if you want to know over the course of the year, what did the shareholders earn on their invested capital? Because remember, they each put in 50 ounces of gold up front, and they had to wait a year. So the question is, if the shareholder asks his accountant, how's that investment doing? Did I make a mistake when I put my money into that particular venture? Maybe I should have bought a government bond, or maybe I should have put my money in a grocery store. How are we doing with that particular bank investment? Well, the accountant's going to say, well, you put in 50 ounces a year ago, and now, as of today, I ran the numbers, and the balance sheet of that particular bank says that they have 1,100 ounces of gold in total assets, no liabilities, and you're an equal shareholder with 19 other people. So that means your aliquot share of the company works out to 55 ounces. So you have earned a 10% return on your money in a year. And so, given the riskiness of this operation, you can compare it to other potential investments, but that's how you did so far. And right now your money's pretty safe. It's sitting in yellow metal discs in a vault. So, you can decide for yourself if you think that was a good thing for you to do with your money. Okay? I probably just should mention, in this example, when those loans were made to Jim and Sally, the money supply did not change in the community. Right? All that really happened was the investors effectively took some of their money and handed it over to Jim and Sally, and they went out and spent it. All right. So to the extent that Jim and Sally pushed prices up by spending money in certain areas of the economy, in a sense, you could say, well, that was counterbalanced by the fact that the investors had to reduce their own spending because that money that otherwise would have been in their cash balances now wasn't in their cash balances. Okay, so it's the total stock of money in the community was unaffected by those loan transactions. It's just the people who were in possession of the money changed for a year, and then it reverted back to the shareholders. Okay, next slide. Number 2, default. So here we're going to assume Jim still pays back his loan, but Sally defaults on hers. So let's make sure we understand the numbers, and then we'll talk about the significance. On the asset side, there is now only 620 ounces of gold in the vault. Because remember, there was a 200 originally, and then Jim paid back 420. And so that's where the 620 comes from. Sally just calls the bank up and says, I'm sorry, I have nothing. I went out of business. I owe a bunch of people money, and I have no assets. What are you going to do? You can try to send me to jail, but I got nothing for you. Okay, so the bank just writes off that loan and says, okay, that's Sally's never going to pay us. Right? So in the real world, a lot of times when somebody defaults on a loan, they still pay something. It's just they don't pay what they were supposed to. Here, just to keep things simple, I'm assuming Sally pays nothing, and there's no hope that she ever will. So the bank is completely eliminating her IOU from its asset side of the balance sheets. That would be called a write-down. That originally they had that thing carried on the books saying she was going to pay them, 480 ounces as of when it matured. And then they come to find out, nope, instead of getting 480, we're getting jack. So they write that down. Okay, so because of that, now the assets are only 620. When all is said and done, the smoke clears. What does the bank have to say for itself? It has 620 yellow metal discs sitting in its vault. Nobody else owes it any money. Technically, Sally did owe them money, but she went bankrupt, and legally speaking now, that's just gone. And but the bank doesn't owe anybody else money, so its liabilities are still zero. So what that means is, of the 620 ounces divided 20 different ways, that's 31 ounces of equity for each shareholder. So a given shareholder asks his accountant, how did we do this year on that particular investment? They're going to say, well, sir, you lost 38%. You put in 50 a year ago. Right now, your share of this bank's assets entitles you to 31 ounces of equity. So going from 50 to 31, that's a 38% loss. Not too good. All right. Let me just mention one other little subtlety. This is high-level stuff, or higher-level stuff. Strictly speaking, as the year is passing, I'm not showing the bank's balance sheet 6 months into these loans. Okay, strictly speaking, the IOUs from Jim and Sally, it's not that they're carried at 400 ounces for 364 days, and then boom, the day of maturity, they all of a sudden jump up to 420 and 480 respectively. That's not the way it happens. They appreciate in market value smoothly over time, or technically exponentially, right? That as they get closer to maturity, the discount on their future value drops, so their current market value rises. So 6 months into it, the bank on its asset side is going to be carrying those IOUs somewhat halfway between 400 and their ultimate value. I mean, not quite, because things grow in percentages. It's not you get what I'm saying? It's not a uniform thing, but they're going to be in between those two values. And so they're going to, the bonds or the IOUs from Jim and Sally, their market value is going to increase steadily until they just reach 420 and 480 on the day that Jim and Sally have to pay them the loan back. Okay, and by the same token, then the shareholder equity at any time during that year slowly increases in accordance with the increasing market value of those IOUs. So in particular, 6 months into the loan, if for some reason the bank needs to raise money, it needs liquidity, and it sells off those IOUs to some other bank that's willing to sit on them for the remaining 6 months, the first bank is going to get more than the 400 that it originally lent out. It's going to be able to sell those IOUs for some number higher than 400, but less than 420 in the case of Jim's IOU and 480 in the case of Sally's, because the other bank that's buying them is still going to have to wait another 6 months to actually get paid off from Jim and Sally. So everything I've written in these balance sheets is correct. I just want to make sure you understand it's not that all of a sudden the shareholder equity goes from 50 to the higher number instantly, or even in the case of the loss, probably if the bank's personnel are on the ball, they're going to see that Sally's probably not going to be able to pay the bank. It's not that the IOU from Sally's going to be carried at its full value, just chugging along, appreciating, and then boom, the 365th day, it gets marked down to zero. Probably, if they're smart, they're going to see that coming and start to take that into account as Sally's business continues to flounder during the course of that year. Okay, next slide is leverage. Slide with the letter C called leverage. So here, I just want to walk you through the same scenario, but now I'm going to change the initial assumption. Instead of the 20 original shareholders each putting up 50 ounces of gold apiece, instead, the way the bank is going to get the original 1,000 ounces of gold in the vault that's going to then lend out is that the shareholders are only going to put up half the money. So now the 20 shareholders, so we still got 20 shareholders in both cases, but in this second case with leverage, each shareholder only puts up 25 ounces of his own money. And then where do they raise the other 500 ounces? They go out into the community, and the bank issues certificates of deposit, or what's called CDs. And they have these standardized, legally binding contracts where the bank says, hey, if you give us 1 ounce of gold today, we'll give you this CD. And what the CD does is it entitles you in exactly 1 year's time to come in and give it to us. And then at that point, we'll give you 1.01 ounces of gold. All right, so you'll earn 1% on your money, but your money's going to be tied up for a year. Okay, so it's crucial to understand this is loan banking. These 500 people in the community who each lend 1 ounce to the bank, they're not depositing their money. They're not opening a checking account. They can't go around writing checks on this money that they've given to the bank. Okay, it's not their money anymore. They are lending it to the bank. Just like when the bank lends to Jim and Sally and they go out and spend it, the bank, that's not the bank's money anymore. All right, it's exchanged present money for a claim on future money, for an IOU. And it's the same thing with respect to the shareholders, with respect to the people who buy the CDs. They are lending money to the bank, and they're renouncing their claims on that money, and what they're getting instead is a CD, which is a legally binding claim on future money. Okay. So the rest of the numbers are fairly similar. It's still 1,000 ounces on both sides of the balance sheet. But one way that you can quickly tell that in this situation is more leveraged is that what's called the debt to equity ratio has changed. So originally, the bank had no debt. And again, to make sure you don't get mixed up here, I'm talking about the bank itself. So yeah, there was debt in the first example because Jim and Sally went into debt, but we're not talking about them. We're talking about the people running the bank from their point of view. What has changed if they don't put up as much of their own money and instead they borrow from others in order to fund the same loan portfolio? We're saying here now, so originally they didn't do it with any debt. They raised all of their money that they were going to then lend out. They raised it all through what would be called issuing equity, or taking in capital, becoming capitalized. Here, they're only half of it is shareholder equity or capital, and the other half is raised through debt financing, through going into debt. So at this point now, the bank is indebted 500 gold ounces to people in the community. So the debt to equity ratio went from 0% to 100%, or you could say from 0 to 1 to 1 to 1. Now, the reason I'm pointing this out here, this issue isn't going to come up so much in this particular lecture, and I don't even think Rothbard gets into this stuff. The reason I'm mentioning it now is later on, when we want to understand what happened with the housing bubble and why, when certain banks failed, and we'll see a lot of people were saying, well, gee, the reason low interest rates weren't helping the banks in the fall of 2008, and the reason we allegedly needed to have the TARP program was that the banks were suffering from a capital problem, not a liquidity problem. And so that's why I'm emphasizing some of these things. And then also you say what happened with some of these banks is that they were very, very leveraged, sometimes 50 to 1. And I just want you to understand what that means. It means that in terms of how much equity did the shareholders have at stake, versus how much did they owe to others. So just to make sure you understand where that number came from here, the debt to equity means what's the debt of the bank right now? It's 500 ounces of gold. What is its equity? It's also 500 ounces of gold. So that's where the 100% or the 1 to 1 is coming from. So when you hear about certain, like long-term capital management, I don't remember off the top of my head what its debt to equity ratio was, but it was big. It was a lot bigger than 1 to 1. It was some big multiple, like, I'm making this up, but something like 35 or 50 to 1. And the way they would make their money is they would take trades that just had a very, very small rate of return on them. They would look for what seemed to be arbitrage opportunities, of difference between bonds that were older and ones that were just coming off the auction block, but that were economically equivalent. And for some reason, people had a slight preference for the freshly issued bonds, and so there's a slight price discrepancy that theoretically there shouldn't have been. And so long-term capital management, one of their strategies is they would go in and buy one and short the other to gain that little differential. But it was a tiny little differential. But the way they made huge returns is they levered up. So they would borrow a ton of money from other people and then really magnify their exposure to that particular trade. And so long as the trade worked and they had what originally would have been a slight little gain, because they were so levered, it got magnified. But then, of course, the problem is, well, we'll see what the problem is. We'll see both the benefits and the dangers of engaging in leveraged transactions or investments. Okay, so the next slide is payback. Number 1, payback. Same scenario as before. Jim and Sally both pay off their loans. Now, when all is said and done, when the smoke clears, there's less gold in the vault than in the first payback scenario, but that's because here, remember, the shareholders only put up 500 ounces of gold originally, and they borrowed the rest. All right, and so this scenario now assumes not only did Jim and Sally pay off the bank, their IOUs, but then the bank turned around and paid off the CDs, because the 500 creditors of the bank showed up a year later and said, hey, here's my CD. You promised me 1% interest on my original loan to you. And so the bank has to pay off those 500 people. So that's 500 ounces in principal plus 5 ounces of gold total in interest to all those people. All right, so when all is said and done, if you do the numbers, you'll see that there's 595 ounces of gold left in the vault. That works out to 29.75 ounces per shareholder. And the percentage rate of return, because originally now in this scenario, each shareholder put up 25. Now a year later, they end up with 29.75. You do the numbers, that works out to a 19% rate of return compared to a 10% rate of return for the same successful loans in the first scenario. So that, let me just make sure you see where that number comes from. That number is very intuitive, that 19%. Because effectively what's happened is the shareholders only put up half as much money, and yet they got the same absolute return, right? They still made the same loans to Jim and Sally in terms of number of physical ounces, and so Jim and Sally paid back those things plus the same size of interest payments. And so since the investors only put up half of the money, their rate of return would have been doubled on that score. But it's not 20% because they didn't get to borrow the money for free. They had to pay 1%. Okay, so to put it differently, if the investors in the bank, if the shareholders could borrow from the community at 0%, if they could have issued CDs, raised money, and not had to pay those lenders anything, then by going from 0% debt to equity to 100%, they would have effectively doubled their return because they would have had the same absolute return, yet only putting up half as much money. But they don't actually earn 20% rather than 10%, which is a doubling, because there's that 1% in finance costs. Okay, so they can't become leveraged for free. They had to pay 1% in interest to the lenders. Okay, so that's where the 19% is coming from. It's a doubling of the original scenario, but minus 1 percentage point. Okay, now, so you see the benefits of leverage. If everything goes well, you earn a higher rate of return as a shareholder. But now, what happens if things don't go well and you see, well, there's a bigger chance of loss, or the loss is more severe when a loss does occur? So you run the numbers in the second scenario where Jim pays back his loan, but Sally totally defaults, and there's no chance she's ever going to pay anything, so that IOU is completely gone. It's still the shareholders are still legally on the hook to pay those lenders, the people who bought the CDs from the bank and lent them 1 ounce each, hoping to get 1.01 ounces next year. There was nothing in that contract that said, unless we have a bad loan, in which case we don't owe you anything. No, that the people lending to the bank, they don't care what the bank does. They're saying, you promised me, no strings attached, no conditions, no clauses, that you owed us this money. And so the bank, so long as it's able to, still has to pay them. Put differently, the shareholders don't have any claim on any of the assets until their creditors are satisfied. So they still have to pay off the CD holders the same amount, the 500 ounces plus 5 ounces of interest. So you run the numbers. Now that's left in the bank vault when the smoke clears is 115 ounces of gold on the left side, and that works out to 5.75 ounces per shareholder. So going from an original 25 ounces down to 5.75 ounces, that's a loss of 77% instead of the 38% loss that we calculated in the first scenario. Okay, so here you see leverage works the other way too. It magnifies your losses. And so where that 77% comes from is a similar thing. 38% doubled would be 76%. So just because of the leverage per se, the fact that the investors only put up half as much money, now that there's a loss, the loss gets doubled because it's the same absolute loss of money, right? Sally has still lost them 400 ounces of gold. I mean, that's the absolute magnitude of the loss on the books. 400 ounces disappeared. Or depending how you calculate, you could even say 480 because you thought that's what she was going to pay you, and now she pays you zero. So depending on what time frame you're looking at, the loss is either 400 or 480. But the point is, the size of the loss is the same in terms of physical ounces of gold, but in terms of rates of return on the original investment, obviously that's a bigger loss when your original investment was only half as much. And so that's why from that fact alone, the loss would now be 76%, not 38%, but it's even more. It's 77% because on top of that, in order to become leveraged, they had to pay 1% to the lenders, the people who bought the CDs. So that's why it's actually not 76%, but 77%. Okay, so that's you can see the rewards and risks of becoming leveraged, that it magnifies the gains or the losses in percentage terms relative to the case of where you're not leveraged. And so, again, working through these examples, when you understand these basic principles, that should shed light for you on discussions that people have about when the banks were really in trouble, and people say stuff like, oh, well, the reason the banks aren't lending right now, it doesn't matter that they can borrow from the Fed at basically 0% and then make loans. They're not doing that because they're capital constrained. Their balance sheets are so shot right now. They need to go out and recapitalize. It's not a matter of them borrowing money. It's a matter of them taking in new investment, new capital to bolster their balance sheets. So I'm hoping some of you have heard talk like that, and I'm explaining to you what that means. Because if you've got a bank that had a lot of bad loans, and so they had to write off a lot of their assets, and now they're starting in the fall of 2008, let's say Lehman just crashed and everything, and they have a bunch of bad loans, and now they're starting out with very little shareholder equity. Just because you come up and say, hey, I'm willing to lend you money at 0.1%, so don't you want to go and borrow a bunch from me and then go lend it out? Well, they don't want to do that because then they become really leveraged. You see? So, yeah, if the loans work out, if the people they're lending to pay them off and they're earning a higher rate of return on those loans than what the Fed or whoever is willing to lend to them for, sure, they earn a nice profit and they can dig out of that hole. But the point is, it's very risky when you start out with a very low base of shareholder equity to then become massively levered by taking in a bunch of loans from one party and then lending it out to somebody else. Okay, so that's why I'm focusing so much on this. I want you to understand that. And that's why with the TARP program, people were saying, okay, it's not the banks need to borrow money. We need to invest in the banks. We need to have new shareholders, namely the U.S. Treasury, come in. Okay, because think of it this way. If you raise capital by having more investors come in, so you're increasing the number of shareholders, in a sense diluting the proportional ownership of the existing shareholders, what you do there, that's the opposite of becoming levered. That dilutes the rewards and the risks. The more shareholders you take in, and the more capital you bring in, because then there's a bigger base. So if for a given size return or loss, or profit or loss, it gets split up among more people who can weather the storm. So that's the difference between raising your funds through equity, through selling shares in the company or just bringing in more investors, versus selling bonds and bringing in more debt finance. Is that with the investors, you all sink or swim equally, and so you sort of dilute the risk to any one shareholder, the more shareholders there are. Whereas with debt financing, you owe those creditors the same dollar amount, or in this case, the same ounces of gold, regardless of the success of your own portfolio. So if you do well, then that means there's more left over for you because you have to pay them a fixed amount. But if you do poorly, that means there's a lot less for you because you still have to pay them that fixed amount. Okay, that's the idea. Okay, so let's move on now. Slide number 3, fractional reserve deposit banking. So here with the pictures, I'm stressing that this is what Rothbard does not like. So all that stuff I talked about before, that happens in a pure market economy that is stamped with approval from Murray and Rothbard, whereas here, this is fractional reserve deposit banking. Okay? So the stuff I'm walking through here, Rothbard thinks is illegitimate and fraudulent. To repeat, in a free market, banks are going to make bad loans. Some banks are going to make so many bad loans that they can go out of business. There's nothing fraudulent about that. The stuff we talked about in the earlier example where Sally defaults on the loan, Sally's not a criminal unless she, falsified the loan documents and said her income was something when it wasn't. Or, she said, I'm going to use this money to buy supplies for my factory, but really she went out and bought heroin with it. I mean, that's, unless she's a heroin dealer because it's Libertopia. You get what I'm saying. That the mere fact that a loan officer approves loans that turn out bad, or that a business person borrows money and then can't pay it back, that's not criminal. That's not fraudulent. There's nothing immoral about that in Rothbard's system. The problem comes in under deposit banking when it's fractional reserve deposit banking. Okay, so the next slide, A, taking into the deposit. So here I'm going to walk you through a simple example, and just for simplicity, I'm not dealing with shareholders who are investing their own capital in this bank. But in reality, even with a fractional reserve deposit bank, you would need shareholders to put up some of their own money just to get the thing going. Okay, and just in terms of the accounting and also with legal requirements, you couldn't just start a fractional reserve commercial bank and not have any investors. You couldn't do that. But I don't want to confuse you. I want to really home in on the fractional reserve checking accounts per se and where the money creation comes from. So that's why I'm not dealing with that stuff. So just keep that in mind. Once you have those issues down from the previous discussion about how the banker's capital interacts with taking in loans from the community and then making loans to bank customers, once you understand that in the case of loan banking, well, that's also going to be going on with actual deposit banking with 900% reserves. It's just I don't want to mix the two things up because it might be confusing. Okay, so in practice, modern commercial banks do a mixture of the two things we're talking about. They take deposits and they borrow money and they take in capital from shareholders, from investors, and then they go and do all that stuff. Particularly investment banks clearly mix all those things as well. All right, so, I should say the investment banks that own commercial banks as well. So it gets tricky where you've got a given bank that's taking, in shareholder deposit or shareholder equity, and then it also takes in deposits from customers who think they're opening checking accounts, and it also sells CDs and stuff like that. So you've got a modern bank blurs all of these theoretical conceptual distinctions that we're going to make to understand Rothbard's viewpoint. Okay, but back to this slide again. We're on the slide that says A, taking a deposit. So the scenario I have in mind here is that this guy, Billy, walks into the bank and he's got a bag with 100 ounces of gold coins in it. He hands it over and says, hey, I want to open a checking account. And so just to be clear, he says, now this, I can spend this money, right? This is my money. I'm not lending this to you. This is my money, right? Because Billy has read up on Rothbard and he thinks he knows how the world works. And the bank says, oh yeah, sure, that's your money. Here's a checkbook. You can go around town. You don't have to call us. Your money is always going to be there, and you can write checks. And in fact, if you ever have a problem with our bank, you can come in the bank. As long as it's business hours, the bank's open for business. You come on in, and whatever your balance is at that moment, we will go to the vault and take out that many gold coins and hand it to you and say, have a nice day. Okay, so yeah, this is what's called a demand deposit, or a lot of people in the community will call it a checking account, that you can just go around writing checks on it. So yep, this is your money. There you go. Thanks a lot. Okay. But even though that's the case, next slide, B, making a loan, what does the bank do? It doesn't just have Billy's 100 ounces or 100 metal discs sit in the vault. The banker says, well, that's crazy. That money's not doing anything. It's just sitting there. And, Billy's probably not going to show up and want to withdraw the whole thing. Or, of course, more realistically, they have thousands of Billys, and they know that not all 1,000 of them are going to show up. So what happens here is, so they want to loan it out, right? So here, I want you to pay particular attention to how I did this slide. So this guy Guido walks in, looks surprisingly like Arnold Schwarzenegger, comes up, he applies for a business loan. And he says he needs 90 ounces of gold, and the bank, looks at the model. It's something wacky about doing a biography of some funny German economist that the banker's never heard of. He says no one's going to be interested in that kind of book. But, all right, you seem like an intimidating guy, so I'm going to approve the loan, but we're going to charge you 20%. Guido says, all right, that sounds good. So Guido signs the document and so forth. So now, and I did this on purpose, there's two ways the bank could give Guido the money. One way would be to hand him, to open the vault and take out 90 of the yellow discs and put it into a bag and hand it to Guido and say, there you go. But Guido doesn't want to be walking around town with a bag clanking full of 90 ounces of gold. I mean, even though Guido is a big guy, he could probably defend himself. He doesn't need to welcome such assaults. It's much more convenient if he goes around with either banknotes or a checkbook. Okay, so back in the day, the bank may have just given Guido paper notes issued from the bank that said, the bearer of this note can redeem whatever, 1 ounce of gold, or there could be a 5 ounce denomination or a 10 ounce. And so they would count them out to add up to 90 ounces and hand them to Guido. And then he would walk out after having signed his name saying, in 1 year time, I owe the bank, 180 or 108 ounces of gold. The 90 principal plus 18 in interest payments in 1 year time. Okay, so that's how it could have happened way back in the day when individual banks issued their own idiosyncratic notes. But in our time, that's not how banks operate. They just give you a checking account. Okay, so now Guido walks around with checks tailored to that specific bank. So a merchant, if Guido tries to write a check drawn in crayon, and that he printed on his home printer, saying the Guido Bank of Austria, of course the merchant's gonna say, what the heck is this? But if it's a reputable looking bank that, the check looks professional, the merchant's gonna say, oh, okay, yeah, I've heard of this bank, this is fine. Okay, so what I'm saying in this slide here, look at this carefully, there's still 100 ounces of gold in the vault, and the bankers are still counting that as assets. And now on top of that, the bankers are counting the 90 ounce IOU from Guido is an asset too. Because in their mind, they're saying, no, this is a legally binding contract he just signed with us, and he's a smart guy. He's going to come up with the money, even if that weird book he's writing doesn't pan out. He's probably going to just go shake somebody down for it, so we're going to get paid. So this is clearly an asset. And we still have the 100 ounces in the vault. And the way these fractional reserve bankers work, they think money in the vault is our money. We can, that's our asset. So the asset side is 190. So we know because of the double entry bookkeeping, it's got to be the case that the liabilities and shareholder equity have to equal 190. And so where does that come in? Well, right now there's still no equity. Okay, because nothing is, all the bank has done is made a loan. That per se doesn't earn them income. They earn income over time through interest accrual. So right now, at the moment of giving that loan to Guido, they haven't earned anything. So where that 190 comes from on the right-hand side is the fact that Billy still thinks the bank, that he has a claim on the bank of 100 ounces of gold. That at any time he wants to, he can either write checks or he can show up and withdraw his money. So when the bank, legally speaking, wants to say, what are our liabilities? Well, Billy has the right to withdraw 100 ounces of gold, but so does Guido. Okay? So it's true, Guido didn't walk out of the bank. He didn't want to walk out with 90 ounces in metal, but he could have if he wanted to. And now with his checking account, if he wants to, he can go to a bank and write it out to cash. If you've ever done that, if you write a check out to cash and give it to the bank, they give you cash for it. Okay, so he can do that if he wants. It's just he doesn't want to do that right now. And in any event, if he writes checks to merchants in the community, then this bank is going to be obligated, if the people who get those checks want, to hand over physical gold. Okay, so now the assets and liabilities are 190 ounces. So when we talk about, so notice what happened here is the bank's balance sheet expanded or grew because of granting the loan to Guido. And that's why I did it this way. I didn't want, because probably most of you, when you hear examples like this, you're thinking, okay, first there's 100 ounces in the vault, and then they took out 90 and gave it to Guido, and he walked away. But what I'm trying to isolate and show you is no, the first thing that happens conceptually in terms of the accounting is the mere granting of a loan to Guido all of a sudden increases both sides of the balance sheet. And to the extent that Guido may not withdraw the money, then at that point in time, in that period, the money supply or the money stock in this community is now bigger. And what do I mean? Well, I'm saying to the extent that we consider checking account balances or demand deposit balances part of the money supply or the money stock, clearly it's gone up by 90 ounces. So if Billy is the only person in the community originally, it's gone up by 90%. Now, of course, there's a lot other money in the economy, so it hasn't gone up very much. But you get the idea. Okay, so this is the sense in which fractional reserve banking increases the money supply, at least depending on how you define it. So obviously, it hasn't increased the amount of physical gold, what we would call reserves, but it has increased M1. All right, and later on in the course, we'll define what's the difference between monetary base reserves, M1, M2, that kind of thing. But I'm saying this is what Rothbard has in mind when he says fractional reserve banking can increase the money supply. Another thing, I keep using different terminology. Strictly speaking, I think it's more appropriate to say money stock or quantity of money, because money supply, like you say, what's the supply of apples? There you have in mind a supply curve, meaning at various hypothetical prices for apples, what's the quantity of apples that merchants would want to sell. So when you say money supply, by analogy, strictly speaking, that should mean at various purchasing powers of money, how much money do the producers of money want to bring to market. But obviously that's not what we mean. Usually in everyday conversation, when you say what's the money supply, you mean what is the quantity of money in existence right now. Okay, so that's... it's hard for me to avoid saying money supply because it sounds so natural, but that's why I keep catching myself and saying money stock or quantity of money. Okay, next slide. C, the reserves flow out. So now here, what's happened is Guido went around the community with his checkbook and he starts writing checks with various merchants. He's got to go, buy a laptop, let's say, because he's got to write his masterpiece biography of Mises. And he's got to go interview some people in Vienna, so he has to go buy a plane ticket. All right, so he's writing checks on his business checking account, getting ready for doing all these things that he needs for his business. So now, as that happens, so he'll, let's say, go to the airline. He writes a check for whatever 1 ounce of gold for an airplane ticket. The airline takes it, deposits it with its own bank. And then what does the airline's bank do, assuming it's not the same bank that Guido banks with? Well, they say, okay, we have a check saying transfer from the account of Guido Haussmann 1 ounce of gold to the account of John Delta, the founder of Delta Airlines. Okay, and John Delta is a client in our bank. So what does that bank do? It calls up Guido's bank and says, hey, we have this note written by one of your customers to one of our customers, so, settle up. Now, in practice, of course, the banks, they don't need a physical transfer of gold for every single check that's written. What they do is they wait a certain period of time, and then they just cancel each other out, and they only pay each other whatever the net difference is. Okay, so really what would happen is after a week or a month, all the banks in the community settle up with each other, and then there's a net physical movement of gold, so everyone becomes square based on who had more checks written on their bank's customers than vice versa. Okay, so, but abstracting away from all that, to keep it simple, just assume there's nothing else going on, then Guido completely drains his checking account. So he writes checks until he thinks he's out of money. And so all those checks eventually find their way back to his bank that gave him that loan initially. So now what happens when the smoke clears? So that bank has to take out physical gold, put it in the armored cart, and drive it over to these other banks that are demanding payment because they have checks that Guido wrote, and the checkbook was given to him by this bank. And their own computers, their own ledgers said that, yep, Guido has 90 ounces of gold in his checking account with us up front, and so that's why they satisfy the claims for redemption. Okay, so in terms of the balance sheet, what happens? Now there's only 10 ounces of gold left in the vault. Originally there was 100, and now as those checks come rolling in, it gets drawn down to now there's only 10 ounces in there. But they still have that 90-ounce IOU from Guido, so there's still 100 ounces in assets. There's now just 100 ounces in liabilities. Okay, so the balance sheet of this bank now has shrunk down to 100. But notice the composition is different from the original scenario. When Billy first put in his 100 ounces, the balance sheet was still 100 ounces of assets and liabilities, but the composition of the assets was 100 ounces in the vault. At that point, it was still 100% reserve banking, but now it's only 10 ounces are in reserve and 90 ounces are owed to it by Guido. Okay, so in particular, at this point, if Billy shows up and wants to withdraw more than 10 ounces of gold, or if Billy writes checks for more than 10 ounces of gold, this bank is going to be in trouble. It's going to have to default. It's going to have to close its doors because everyone's going to realize, whoa, you can't trust that bank. Merchants aren't going to want to accept checks written on this bank if it gets caught with its pants down. So that's why the bank has to be careful. Okay, but right now, technically, disaster hasn't struck. These bankers are still okay because they still have 10 ounces in the vault. And Billy, they just hope, doesn't spend more or want to withdraw more than 10 ounces before Guido pays off this loan. Okay, next slide, D. The German does well. So Guido's book is a hit, gets good reviews from Israel Kirzner, all sorts of other experts on Mises. It sells really well, and he ends up earning 128 ounces of revenues, of net revenues. Okay, that because maybe he has people that did work for him or something, and we're going to get paid out of the share of revenues. People were going to get a cut based on how well the book did. But when all is said and done, the smoke's cleared. He has 128 ounces from his business, from selling his book. So what does he do? Well, what does anybody do when you get a bunch of money? And let's just suppose, for the sake of argument, he gets paid in physical gold coins. Well, he goes to his bank to deposit it into his checking account, right? That's what everybody does. So after that happens, what does this look like? Now there's 138 ounces of gold in the vault, the original 10 from the last slide, plus Guido's 128, and so the asset side is now 228 because there's still that IOU from Guido. All right, so I'm breaking up the transactions here. At this point, Guido has not paid back the bank. All he's done is made a deposit into his checking account. Okay, so that's still Guido's money, legally speaking. Okay, maybe he did this 2 days before the note was due. Okay, now, and you can see that the right-hand side is 228 because Billy's still 100, and now Guido's balance is up to 128. Okay. Next slide, finally, we see the completion of the process that the Guido pays off the loan. The 90-ounce principal plus the 18-ounce interest because it was 20% interest rate. So how does he actually do it? And this is, this is the opposite of that first transaction when they granted the loan to Guido before he actually spent it. And it was just a bookkeeping accounting entry that magically increased the money supply. Well, here, that operation happens in reverse. So remember, Guido, looking back at slide letter D, Guido owed the bank 108 ounces because it was the 90 plus it had grown to 108 from interest. And he had 128 in his checking account. So what do you do when you owe somebody money? You write him a check. And so Guido, it happens to be that the recipient of this check is Guido's own bank. But that's fine. So Guido goes into the bank. He says, hey, today I owe you 108, right? And they say, yep. And he says, okay, well, I'm going to pull up my checkbook that happens to be with you guys and write you a check for 108, pay to the order of whatever this bank is, Shady Bank Incorporated, maybe the Steve Horowitz Bank, because Steve Horowitz is in favor of fractional reserve banking, 108 ounces of gold, signed Guido Hulsman, rips it out, gives it to him, and then Guido in his checkbook, he says, okay, I had 128, and I just paid 108, so now how much? So now Guido thinks he has 20 ounces left in his bank balance, and that's, of course, the bank's computers agree. Yep, now you've got 20 ounces left. But from the point of view of the bank's books here, what happened? That loan disappeared because it was paid off. And now the outstanding liabilities, Billy still thinks he has 100 ounces in his checking account. and Guido thinks he has 20 ounces in his checking account. All right, so there's a discrepancy there. There's 138 yellow metal discs sitting in the vault, and yet there's only 2 people who collectively have claims to 120 of them. So that 18 difference is the equity, the 18 ounces. So there's 18 gold coins now in the vault that are unspoken for. And so that means that's the excess now. Now assets are higher than liabilities by 18 ounces, and so that's what shows up as the shareholder equity. And so the shareholders now of this fractional reserve bank, Steve Horowitz and his cronies, now have 18 ounces free and clear. If they wanted to, they could withdraw that and spend it. They could take a dividend from the corporation of the bank, and they wouldn't be getting in trouble. Okay, because that 18 ounces is totally free and clear. Okay, so two more things to note on this slide before we move on. We're running out of time here. Just as the granting of the loan to Guido expanded the money stock, by the same token, when Guido writes that check for 118 or 108 ounces and gives it to the bank, and they process it, they eliminate his loan, and then they clear the check, and his checking account balance shrinks. That money just disappeared from the economy. Okay, so it's a little bit odd, perhaps, but that money just disappears because it's how can I put it? Normally, we think that when I write a check to you, that the bank just debits my checking account but credits yours, and so you think the total M1 doesn't change, and that's true. But if you're writing a check to a bank, to your own bank, I should say, so the way they process that is they simply reduce how much your outstanding checking account balance is. That just lowers their liabilities in a fractional reserve banking situation. Okay, so it's not that when you write a check to the bank that your account goes down, but their account goes up. Because as we can see here, when they lent the money to Guido in the first place, they didn't draw down the money from somewhere. They just said, okay, here you go. They just gave him an account and just put a number on it, put 90 on it. So that's yours now. That 90 didn't come from anywhere. Okay, and again, that's why I purposely did that. I didn't want to just have them take out 90 from the vault and hand it to Guido, because then you would be thinking the bank loan isn't creating money, it's just taking Billy's money. But that's not what happened there. In terms of the accounting, they created that 90 out of thin air and just gave it to him. In theory, just to drive home the point, the bank could have given Guido a loan for 9 billion ounces of gold and just credited it and given it to him. Now, of course, that would have come back to bite them if Guido ever spent too much of it. But the point is, the loan itself is what was creating the money. Again, if we count the money stock as including checking account balances, which is a very plausible thing to do in a modern economy. Okay? And so then going the other way, if you buy that, it's got to be the case when Guido writes a check on his account to that same bank, the way they handle it is it's not that there's this tangible amount of money that gets transferred from his account to their account. They don't have an account. They create money or they destroy it. And so it's the same thing in reverse in that situation. Okay. One last point, and then we've got to move on. That 18 in equity. That number, it's not a coincidence that number is the exact interest payment that Guido had to make. Okay, so the bank ends up with 18 ounces in equity, and that's exactly how much interest that Guido had to pay. Okay, so that's the whole point of fractional reserve banking. Loosely speaking, under fractional reserve banking, the bankers create money out of thin air, lend it to somebody, and then that person pays back the principal plus the interest. And so the loan is extinguished, the principal disappears, but the interest remains, because that's what the person paid above and beyond the money that was created. Okay, so when it's a commercial bank doing fractional reserve banking, this is kind of an important but subtle point. The bankers do not. It's not that the bankers create money and then go spend it, right? It's not that the bankers give each other checking account balances and then go buy their wives mink coats with them. That would be foolish because that would eventually catch up with them. And the same thing with the goldsmiths back in the day. They didn't have 1,000 ounces or 100 ounces of gold in the vault and then print up 110 notes, give the 100 to their depositors, and then take the 10 extra ones and then go and just buy stuff with it, because that would be the end of it. And then they would always be in danger of being caught with their pants down. What they would do is with the extra 10, they would lend them out. And so those eventually would come back. They could destroy the 10, and then the principal of the interest that was paid is theirs free and clear. And so that's what this bank has done here. That 18 ounces now. So in other words, at this point, unless the bankers engage in another loan, right now this bank is 100% reserve. Billy thinks he's got 100 in there. Guido thinks he's got 20 in there, and the bank actually has 138 in the vault of physical metal discs. So the bank right now is totally fine. If there's a bank run, they can pay them off. That 18 is theirs free and clear. And so that's the idea. So the reason at any given point a fractional reserve banker is in trouble is that they keep the process going. Now, in other words, this banker in the next slide, if we continue this story, would make another loan to somebody else, and they would again be vulnerable to a bank run. But I'm saying with the successful completion of a given loan, once that loan is paid off, that new money disappears. It's extinguished, and the banker is left with profit. So where did that come from? Where that 18 ounces come from? Well, it came from the community. Guido produced a biography of Mises that people in the community wanted, and they gave him yellow metal discs in exchange for it. So that's where it came from. So effectively, through fractional reserve banking, Steve Horowitz and his cronies have, if you want to use the term, redistributed the existing yellow discs in the community. And so now 18 more of those discs are in the legal possession of Steve Horowitz and his cronies. Okay? For people who don't know, I'm just making a joke. Steve Horowitz is an Austrian economist who is very much in favor of free market fractional reserve banking. And so I'm just being funny by picking him as the fractional reserve banker. Okay, next slide, because we're just about out of time here. Roman numeral 4, fractional reserve banking under free banking. So I'm going to have to be quick with these last two slides, but I hope by spending so much time on the first stuff, and then also, of course, you still need to read Rothbard's treatment, it'll make a lot more sense now. The stuff Rothbard's talking about will be crystal clear to you because I've walked you through the mechanics of it. So under what's called free banking, usually what we mean by that term, at least the way Austrians use it, is a system or a regime, a property rights environment in which the government does not, it doesn't prohibit fractional reserve banking. So it's not a crime to take in deposits that are considered demand deposits and then to lend some of them out to other people. So if you're a client of such a bank, you can't go to the court system and say, holy cow, that guy, I've deposited my money thinking they were going to put it in the vault and watch it for me, and the next thing I know, they lend it out to some German guy. That the judge is going to say, yeah, what's your point? Okay. In contrast, if you put your furniture in a storage facility and then you saw that the guy lent it out to Guido to have a party with, then you could go bring suit and say, what the heck? Clearly, I expected when I dropped off my furniture that they weren't going to lend it out to or weren't going to give it to somebody else. However temporary they may have thought that would be. And the judge would probably say, yeah, you're right. Okay, but that doesn't happen under free banking. Under free banking, we assume it's legal to engage in fractional reserve banking, but it's sink or swim, right? The government doesn't give you any special privileges as a banker. If you tell people this is a demand deposit account, then you better be able to pay them when they show up. And if you can't, then you've defaulted on your contract. So that's maybe a different way of putting it. Generally speaking, in the Austrian literature, when we talk about free banking, what we mean is it's legal to have less than 100% reserves, but it's not legal to refuse to redeem either a check or somebody showing up at the counter wanting to withdraw their money. That's you've defaulted at that point on your legal obligations. Okay, so Mises and others, and Rothbard doesn't dispute this either. We all agree with the free banker, and also so in modern Austrian circles to talk about the free bankers typically means people like Steve Horowitz and others who have no problem with fractional reserve banking per se, as long as it's on a market, as opposed to under a government sponsored system. So everybody agrees that fractional reserve banking would have certain limits on it, and the idea is that think back to what we showed in the example we went over. When the bank gives a loan to a customer that is based on deposits that somebody else still thinks is their money, well, they set themselves up. They're vulnerable, because now when that customer goes and spends money elsewhere by writing checks, that makes it more likely that when the clearinghouse operations occur, the bank that just granted that new loan is going to owe money on net to the other banks in the area, and then it's going to have a physical transfer out of its vaults of the gold or whatever the money is. That's another thing too. I don't know if I stressed. I'm choosing gold in these examples because I want you to see that fractional reserve banking isn't just about fiat money. Those are two separate things. You can have fractional reserve banking with gold as the money and as the reserve, or you can have it with fiat money. And by the same token, you can have 100% reserve banking with gold, or in principle with fiat money. I mean, that would be weird because you don't have fiat money presumably because of the government, and so the government would want to encourage fractional reserve banking. But conceptually, those are distinct. Okay, so if you're a fractional reserve commercial banker, you have to be careful. You can't expand unilaterally. You can't just start granting a bunch of new loans to people. You have the incentive to, right? Because the benefit of granting new loans, the higher the volume of loans in your portfolio, the more interest you're earning. And as we saw, that's how the bankers get money free and clear that they can then go spend, is by earning interest payments. But they have to be careful, because if they expand more than the other banks in the area, that means statistically their customers are out in the community spending more than the customers of the other banks. And so that just means on average now, when the clearinghouse operations occur, the bank that has expanded more aggressively than its competitors is going to have more net redemption claims on it at the end of the week or the end of the month or whatever the clearinghouse period is. Okay, so its vaults are going to get drained very quickly if it expands more than its partners. Now, okay, so because of time constraints, I think that's the most I can say there. Let's move on. Well, let me just say one thing. The difference in viewpoint is where we predict the equilibrium reserve ratio would be. Okay, so we all agree as Austrians on the principle I just said, that any given bank can't expand too aggressively relative to its competitors under fractional reserve banking in a pure market setting, because it's going to get hit with net redemption claims. But the idea is, if all the banks, let's say all the banks originally start out at 100% reserve ratio, if they all say, you know what, let's try 99%, let's try 98%, let's try as long as they're doing it uniformly, not necessarily because they all have a pact with each other, but just for whatever reason, as long as they're doing it, and no one bank is expanding more than the others at any given time, then it all sort of cancels out. Okay, because the one bank's customers are spending more, but so are the other banks, because all the banks are expanding their loan portfolios simultaneously. And so they all end up canceling out, and there's no net flows of gold from one bank vault to another. Now, of course, in practice, it's not going to be perfect, but you get the idea that as long as the banks are expanding uniformly, there's not going to be any trouble where any one bank is going to get caught and run out of gold in the vault. Okay? So that the mere observation that I just gave you, that if one bank expands too quickly or relative to its peers, it gets hit, that doesn't prove what the reserve ratio is going to be in equilibrium. So the free bankers, the modern free bankers, are going to say, for all we know, it could be 1%. Who knows? And so Rothbard goes farther, and he predicts it would be close to 100%. And just to give you a quick argument as to why that would be, you could say, well, there's always competition. There's always free entry under free banking. And so somebody could just start a new bank. So even if all the other banks, because they see the advantages and maybe they go out to lunch together and they have a secret deal, maybe they go from 60 or 100% to 90 to 80 to 70 to 60 and they get down to 50% reserve ratio and they're not getting pinched because they just, they're canceling out each other's checks. But then at some point, somebody could start a new bank and say, okay, well, I'm going to start a bank that's 100% reserve. And then he jumps into the mix, and now all these other bank customers are going to be writing checks to clients of this new 100% reserve bank. And when the clearinghouse operations occur, there's going to be huge net obligations to the newcomer. And so all the gold from all the other banks is going to start flowing out of their vaults into the vault of the 100% reserve bank. Okay? And so, but again, I just want to point out to you that doesn't prove that by itself that in equilibrium the reserve ratio has to be 100% because, why the new bank that comes into it, but yeah, he starts draining all the gold, and so the other banks start increasing their reserve ratios because they're going to get crushed otherwise. But why would at any given point, the bank that has the highest reserve ratio, why would he keep it at 100%? If the other banks are at 60 when he's at 100, he could still inflate himself and only have like a 90% reserve ratio, and he's still going to be getting gold from them. Okay, so it's sort of like a game theory thing. We can't conclude from what I've just said that therefore in long-run equilibrium, if the government's not encouraging things, then you necessarily can predict that there would be a 100% reserve ratio. You would have to have other things involved, like, for example, people in the community prefer having their money in a 100% reserve bank even if it means they don't get paid interest and stuff like that. All right, so you would need to have other considerations to come up with the argument. But you can see the point that the banks can only they have to have a uniform reserve ratio. You can't have some banks expanding very quickly and having very low reserve requirements, whereas other banks have very high reserve requirements because over time the higher reserve banks would end up just siphoning off all of the reserves from the other ones. The other ones eventually would get caught with their pants down. Okay, so that's the issue under free banking. So now the last slide, Roman numeral 5, fractional reserve banking under central banking. Well, you see that this is the point. That Rothbard views central banking not as it's commonly depicted as this valiant effort to stop the rapacious free market bankers from inflating and the common man has no defense against their rampant inflation. No, Rothbard says it's the exact opposite. The market, left to its own devices, has strong checks on any individual bank expanding. And so it takes the government to come in and form a cartel under the auspices of what's called a central bank to set a common reserve ratio for all the banks so they can all inflate in unison and no one bank gets caught with its pants down. And then another thing that central banks do, according to Rothbard, is they monopolize the issue of paper notes. Okay, so here, we're not talking yet about fiat money versus commodity money. There are still bank notes, even if we have a commodity money as the base reserve money. But the point is, you don't have, under free banking, you would have, Rothbard Bank would issue its own paper notes saying the bearer of this note can get 1 ounce of gold if he shows up at the bank and turns this thing in. And then you'd have the Hulsman Bank and you'd have the Horowitz Bank and so forth. And they would be different notes. So people in the community would have different things in their wallet, notes from different banks to different denominations. Just like right now you could have checks written from different banks. Okay, but again, the difference between a check and a note is that a check has a particular individual's name on it. So it's not just the bank, it's also the individual's account, whereas a bank note is not tied to the person who gives it to you. The note is a more generic thing, just saying the only information on the note is the bank that issued it. So it's closer to a money order, but even a money order, I think the person signs it. But you're trying to get the distinction there. Okay, so what a central bank does is it monopolizes the note issue. So now you don't have individual commercial banks with their own paper notes. Everybody has to use just the notes issued by the central bank. Okay, and again, that's true whether or not the underlying actual money, the reserves, is fiat money itself or is commodity money. Okay, so you can imagine a situation where there's commodity money, and yet you have paper notes issued by the central bank, which are claims on the commodity money. Okay, so why do they do that? Well, Rothbard talks about it, but one main reason is to get people out of the mentality of thinking there's competing banks. Right? If you're a central banker, you don't want people worrying about the solvency in the loan portfolio of individual banks. You want them to just think banking, and that's it. And you don't even have to care where you put your money because it's all backed up, and you're not going to get in trouble because the central bank is the lender of last resort. If any particular bank gets in trouble, the central bank comes in and rescues them. So they don't want the community worrying about the safety of their money, because once you cripple that the market check of banks expanding at different rates, the only thing left to stop just pure inflation of just the bankers creating ever more money so they can earn more interest, the one remaining check on that is a bank run, right? Because it's still the case that people can show up at a given bank and say, give me my money back. And if you're engaging in fractional reserve banking, there's no defense against that, except, like FDR coming in and closing all the banks and calling it a holiday. Okay, but in terms of just normal day-to-day operations and how to keep the public happy, that's the one danger of the So now in other words, the bankers under central banking, they don't need to worry about forming a cartel and all going down to a very low reserve ratio so they can inflate more and earn more interest. They don't have to worry about some newcomer coming in and setting up a 100% reserve bank, right? Because now there's a cartel. The banking sector is now tightly regulated. It's hard to come in and open up a new bank. And so they've effectively gotten rid of that check on inflation. But again, the one remaining check is if Joe Sixpack gets paranoid about the bank and shows up and wants his money, then the game's up for that particular branch. So I think part of what's going on here is the central bank, the philosophy of it is they don't want people thinking in terms of individual bank corporations, because then that makes you think, oh, geez, some might be better than others. You don't want the public thinking like that. You just want them to think there is the money, there is the banknote, and that's it. And so that's why the central bank monopolizes it. So now all the commercial banks, they don't issue their own banknotes. They just use the notes issued by the central bank. So in the United States, it's a Federal Reserve note. You don't have notes from Citibank or notes from HSBC. They all have Federal Reserve notes in the United States. Okay, so we're over time here. Let me stop there. There's plenty more material that's important that's in Rothbard's chapter, the tail end of chapter 8 and chapter 9, and so you're still responsible for that, and perhaps we'll circle back and pick some of that up in later lectures. All right, thanks everybody.